Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Prices start at $9 per month. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Kevin Phillip of Bel Air Investment Advisors, thank you so much for joining the Contrarian Investor Podcast today.
Thank you, Nathan. Nice to be
great to have you. You have a bunch of views that are quite contrarian that we're going to talk about. It is an eventful time in markets. We have the regional bank issue going on as we speak. We're not entirely sure if those are in the clear yet. Already taken out two of them, actually three if you count the first one there out in California. Was it not? I forget.
The one in San Diego that had crypto exposure.
Yeah, they all start with the letter S. So,
yes.
But anyway, but to kick off here, I wanted to start with your most contrarian take, which is that tech is not dead. Tech is not dreck. And this is something today, obviously this is a riskier part of the market. Some concerns about the exposure there to the regional banks. To the extent that maybe tech companies use them and to what extent their deposits might be guaranteed. There's that. And more generally, just the rotation from tech into value, which has gotten a little bit of ink here. So that's where we're at, but you still like tech. So tell me why.
Yeah, I like tech generally. I mean, we're not going to overload it into, at the current levels. It has a lot to do with interest rate outlooks and how multiples are calculated and earnings projections. But I think historically, when you look at the strength of the American economy, there's no economy like our economy that innovates better. And tech is the heart of our innovation. Mm-hmm. Even when you get into non-tech sectors, whether it's energy or banking, even those sectors have benefited from the advancement in the technological arena. Mm-hmm. So I think that will resurface. I think it got ahead of itself, driven by the accelerated tech economy of COVID and work from home, and the swelling of the demand for digital goods and services as we were all stuck in our houses. And I think we're seeing a correction on that. And we're also seeing a correction based on the relationship between the growth sectors and interest rates, as interest rates have been raised so aggressively here.
Yeah, and you raise interest rates there, if you'll forgive the pun. And we just had the Fed yesterday come in and basically say there's not going to be any cuts this year unless the data changes. So what is your view for interest rates the rest of the year?
I'm one of those, maybe it is contrarian to actually believe the Fed. It seems to be the norm to bash the Fed, and the Fed is comprised of some of the smartest leading thinkers we have. I don't inherently believe in some sort of kind of conspiracy theory that they're biased in some way or following an agenda of some sort. I think the Fed has largely been depoliticized recently. I'm not sure if they ever were. Nevertheless, they still get a lot of PR bashing and pressure. And, to the extent that affects them. But the Fed has basically said they're going to be data dependent, and they're going to focus on their goals of price stability, full employment. And I think it's possible we get one more hike of 25 basis points. I think given what we've been seeing in the banking world, these bank failures, I think the chances have risen that we see a Fed cut before year end, if not very early next year. It does concern me, and largely, I think you and I are kind of a similar age. I think we're the same age demographic. I'm hearing a lot of stories of layoffs of folks in the kind of late 30s to early 50s demographic, typically highly compensated, upper middle management, lower upper management. And I think that'll catch up to us at some point as an economy. And if it does, we'll see enough of a slowdown and we'll see enough of a release of wage inflation, which is the primary driver of inflation, that the Fed will be encouraged to cut rates sooner rather than later here.
You're based there out in Southern California, not Northern California, but do you see a lot of that type of action in terms of the layoffs going on in the tech scene?
Yeah, so I was raised in Northern California, just outside of Silicon Valley. I've lived in Southern California for the last 20 years, and I also live in New York as well. So I kind of have a good mix of those types of arenas. And I was just sitting with, I went to Stanford University. I experienced the first .com while in college, participated in a few startups that didn't go anywhere. So I've seen some of this show before, which informs my view of what happened at Silicon Valley Bank a bit, which we can talk about later. But I am seeing very much a change in the employment situation within the tech arena, and a little bit of a how do I say this? Maybe a self-evaluation, recentering of that tech sector itself, and what it means. What they're trying to provide to society, the economy, how they think about themselves, how they approach business, etc.
Talk to me some more about that. I mean, how is that manifesting itself? Well,
it's a kind of a delicate circumstance, but you have a lot of second guessing about business models. What good is certain services providing to our society as a whole? How do they make money? What filters should or shouldn't be on different services, networks, products? There's very much, I think, a race to figure that out. The entrance of AI, example of Chat GPT, very interesting. Bill Gates is on the record saying it's one of the most incredible developments in the last. I'm not sure what time frame he gave exactly, the last decade plus. So there's going to be a lot of interesting developments, I think, driven around that whole ecosystem, and it comes into why I think, to a degree, there was the viewpoint that not killing the heart of venture capital by damaging deposit bases at Silicon Valley Bank probably was determined to be a good idea.
Yeah. But do you think the VC model itself is in any kind of threat? And there was a lot of talk about that right after SVB went under, about how this whole idea of these venture firms and how they wouldn't have any money or whatever. Have you seen that at all, or not so much?
Well, I think it would have been the reality if they either had their funds frozen and couldn't make payroll,
right? If
they lost 20 to 30% of their deposits above the insured limits, which it does surprise me that the basics of banking and safety of deposits and insurance levels has kind of evaporated when we only had a series of bank failures 15 years ago. It seems like those lessons were a little forgotten. There is talk that Silicon Valley Bank required those types of deposits for certain relationships. I don't know to what extent that was true. There was a disturbing article about how Silicon Valley Bank did double its loan exposure to one particular group, which was their own insiders. And there is a lot of cross breeding within Silicon Valley of mutual board members sitting on each other's companies. So it creates this kind of, on the one hand, it creates an echo chamber of success, you could argue, because they're incentivized to help each other's companies grow, but it could also create probably some unhealthy biases as well. And there probably should be heightened scrutiny about independent board members and exactly those interlining interests, especially when it comes to lending and underwriting.
Yeah. Although that's not unique to Silicon Valley. I'm pretty sure, like if you look at Wall Street,
That's fair.
So, yeah.
I just think that when you're talking about venture firms that are so small,
sure,
the growth effect is much larger. It's hard to have as much influence on the success of a company when it's huge, like an energy company or a financial conglomerate.
Do you think any of this has hindered VC's fundraising efforts? Because a lot of that will drive, obviously, this innovation, right? If they don't have money to fund it, then who does? I guess some people.
So I think it's going to actually create opportunity in two areas. I think what's called the secondary market where there's locked up secondary funds go and buy out limited partnership interests in funds before the LP is otherwise going to receive capital. Mm-hmm. So I think the timeline on returns or liquidity events has definitely been extended. The question of whether you make money on those or not has been heightened. But in the meantime, secondary funds will sweep in. This happened in 08, 09, and they'll basically buy those interests for cents on the dollar if someone needs their money or somebody needs to rebalance or an endowment needs to distribute something. So I think it creates an opportunity for investors that actually invest in secondary funds. That's one of the things we're looking at heavily.
Okay.
And then secondly, for new money to go into the venture space, because I think this is in a way a healthy culling. I think business models will become more rational. I think definitely there was a bubble in venture and late stage growth, private equity, and that bubble has burst. And sometimes the best vintage years for getting started with an investment are the years after they burst.
Yeah, no question. But as far as what we're looking at now in the tech space, none of this concerns you as far as the immediate future of publicly traded tech stocks.
So I think publicly traded tech stocks have been heavily beaten to a pulp.
Yeah. And
now that we see kind of green shoots of rate cuts, the primary driver, there's two primary drivers of pricing stocks, right? The PE multiple, and which is informed by what should the PE multiple be in the current interest rate environment we're in, and second, what are the earnings going to be? Mm-hmm. So the PE multiple itself had to contract with a higher interest rate environment. Now that we see kind of the end of the road potentially and lower interest rates, it actually gives support to sustaining multiples where they're at, roughly 17 times projected earnings. And if you have a lower interest rate, the lower the interest rates are, the higher the multiple can be. So it gives rise to potential multiple expansion, which means the stock market goes up. The second part on earnings, I think that is kind of the big kind of question mark right now. And the consumer, it never pays well to bet against the American consumer.
Right.
But there are a lot of metrics that give me greater concern than usual. Credit card debt, increasing costs in car loans, 30% plus, supply constrained housing still, education costs still. So at some point, I'm a little concerned that the consumer's going to show some signs of weakness. There's been, and I can't recall who came up. It was not me that came up with this idea, that the Wile E. Coyote kind of analogy, where all of a sudden we realize there's no ground underneath us. I'm a little concerned that the chance of that happening has heightened, and then the Fed will have to course correct rather quickly. So anyway, if we find us in a Wile E. Coyote moment, earnings could potentially collapse. The projected earnings next year on the S&P is roughly 240 in 2024. And I think there's good news and bad news to that. I think generally speaking, that 240, whether we hit it in 24 or we hit it in 25, we're going to hit that number at some point within the next, within these next 2 years. And the stock market trades 12 to 18 months in advance of those earnings. So with a multiple of 17 times, that puts us at 4,000 on the S&P. So the bad news is I can't quite pencil out a whole lot of upside within the broad market. Individual stocks are a different story. But the good news is if we do have a blip where it takes us down because of a scare of some sort, I think we get back to 4,000 in relatively short order, simply based off of relatively attainable earnings on the S&P, either in 24 or 25.
Interesting.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
So you talk about growth and tech. Are there any, without mentioning individual companies, are there any particular areas of tech? And I'm talking on the early stage side, not public companies, but like early areas. You mentioned Chat AI, Chat GPT. Is there anything else that's particularly exciting to you that you're watching, or that the VC community you talk to is watching?
So forgive me if I say there are a lot. But
yeah, no, it's fine.
Let's just start with kind of the Chat GPT and kind of brainstorm about what that can do. And it can be a little threatening to certain occupations, but what can it do? It can help with marketing materials. Talking to a web developer the other day, he's a web developer / marketing firm, and he was tasked with creating a website for a dental group, a high-end dental group out of New York. He doesn't know anything about dentistry, and he could get the clients on the phone and talk to them about exactly what a procedure is or isn't. But instead, he's a very technologically savvy person. Used Chat GPT to basically create the copy for the entire website, and then had it reviewed and corrected by the actual dentist, who said, wow, this is really pretty good. So you have the ability of just, kind of basic marketing being overwritten by Chat GPT. You have potentially artistry, animation, graphics, logos, all those types of things. I don't know if you've played with the visual equivalent of Chat GPT. I'd encourage you to do that. It's fascinating. You put a couple of keywords in: Caravaggio, bird, tree, woman, tunic, and then it kind of just puts it all together. You could say colors, and then you can tweak it. It's quite interesting. So I think you're going to have a whole genre of companies around this technology that actually increases productivity, potentially threatens jobs, but it accelerates kind of a whole lot of kind of do-it-yourself categories in a way that's pretty efficient. Defense, cybersecurity, blockchain, all categories that are going to be very important. I think quantum computing is something we don't talk about enough, and will become a reality here in the next handful of years, which changes a lot of things, changes a lot of our security protocols, which we're going to have to handle. The blockchain, even though I'm not a believer in crypto, and we can talk about it if you want, but blockchain as a faster transaction validator is I think very valuable. I still think it needs to exist in a closed architecture that's less subject to hacking, especially when quantum computing comes into play. But I think it's a very valuable transaction validation. I think crypto crypto or token currencies, however you want to call it, might play a role in certain ecosystems that get created in Web 3.0. Metaverse kind of examples. And I think we can, the way I describe it to friends, family, clients, it's a digital mall experience. If you're living somewhere in, I don't want to pick a particular geography. If you're living in a distant geography and you want to take a walk on Rodeo Drive or Madison Avenue, and you put on a headset and you can walk around, and you want to join a friend that's in a different state and they're walking next to you, and you're both in your own avatars. Your body looks the way your body wants to look online. You're wearing certain clothes that are branded, that are, an NFT that you purchase from whichever brand you love, and you have your favorite pair of sneakers on. And maybe there's a real world equivalent that you buy also, and you can do an add-on with an NFT. And you go into your brand of choice store, and you pick up an item online. It gets, you buy it in the metaverse, and it gets shipped to you in your home, and it's a shopping experience. And I think there's going to be real value. And even though it's not going to be for everybody, you don't need everybody to make an ecosystem. You probably need 20, 30 million to get critical mass.
Interesting. So cryptos, what do you make of the run-up we've seen in cryptos? They seem to be indestructible. They had the brush with death last fall. And now again, you would figure that this event with the banks, this would be something that would lead to crypto dropping, but it's rallied.
Well, I would say for the most part, other than Bitcoin and Ether, a huge majority of what we saw of crypto and tokens have been trashed.
Oh, okay. I haven't paid attention. Okay.
Yeah. So those, so I think that was a speculative bubble that needed to be burst.
Yeah.
Whether there's a role for Bitcoin or Ether, the fact that certain ecosystems are being built around Ether, and there's certain smart contracts that can be triggered with that, fine. Whether they have their own intrinsic value versus being pegged to the dollar, I think it's more likely to be pegged to the dollar, or there's some sort of crypto US dollar created, which makes more sense to me. And I get bashed by crypto addicts that love that when I say stuff like that, but it's just the point of a currency is stability and the belief that it's going to be there tomorrow. And I don't think there's any intrinsic value to Bitcoin or Ether unless they're backed by an ecosystem that rewards you for owning them or having them or transacting in them.
Yeah, fair enough. All right. Last question before we go to break. With Silicon Valley Bank, so what do you make of that? What and how endemic is that in the broader banking system? Jay Powell yesterday said he doesn't think it is. But what was your take on that, and how prevalent is it?
And this is, I alluded to this just in early on when I mentioned I went through .com 1.0.
Yeah.
In hindsight, which is always 2020, it feels like they didn't learn the lesson of the late 90s, where they were very focused on a single sector, on servicing a single sector. They were adamantly no to you as a borrower or client if you were not in the tech world and preferably a founder. So they serviced a single sector that went through a massive valuation pummeling with the fastest rate increases in modern history. And so you had cash burn, valuation declines, and extended illiquidity, the trifecta. And in hindsight, it makes perfect sense that a sector-specific bank fails under those conditions. I think the bigger question is, there clearly seems to be some indication that was coming, and based on their balance sheet exposure, and the Fed's going to do their own research, their own investigation. It'll be curious to see what they find. But at the end of the day, it seems that it was a poorly managed bank with a too narrow of a business model, and it's not the Fed's job to save bad banks. They took it upon themselves to save the depositors, but the bad banks generally deserve to fail.
Yeah. And so why did other banks get taken down with them? Was Signature Bank in New York, was that the same issue where they were just focused? I don't know.
Signature Bank had different issues, and I think it was more related to real estate and commercial property exposure. But at the end of the day, both these banks had similar problems when it came to the duration of their portfolios and the hit they took on the bond portfolios, particularly as these interest rates rise. So if you buy a 20-year bond, that's a 20-year duration. For every 1% for every one point of duration, you have that amount of decline when interest rates go up 1%. So if interest rates go up 1% on a 20-year bond, it's a 20% decline of market value.
Right.
So we've had hikes of almost 500 basis points. So tremendous decline. They don't have to mark those to market unless they're forced to sell them.
Right.
And so I think both banks mismanaged their duration risk and their liquidity.
Okay. All right. What about Credit Suisse? Any idea what happened there? Because they never really told us, did they? It was just like they were racing against the clock. Next thing you know, it's gone.
Right. Fascinating.
Yeah.
And compared to UBS, Credit Suisse did not take bailout money in 08, 09.
Right.
So they survived. They got through it without taking bailout money. Credit Suisse has been going through a number of issues over the last years with there have been certain scandals about their senior management, have been fighting with each other, and some very interesting stories around that. My understanding is that they had a crisis of confidence driven by a large client base outside of Switzerland, and that combined with their underlying exposures put them in a death spiral.
Yeah.
And the consequence, and it's work. With Credit Suisse, it's systemically important. Sure. There's exposures across the international banking sector to they're the second largest bank, the first one being UBS. So if they went down, they might pull down the first largest bank. Switzerland is known for its banking and its stability of finance. It was kind of a national identity crisis.
Yeah.
So I think that's why, between the systemic importance of CSFB and the national identity that was involved, action had to be taken really quickly.
Yeah. Really quickly. Yeah. In one weekend. which interestingly was a couple of days after they said that there was no systemic risk, but whatever.
Yeah.
Which they're now repeating again, but so we'll see. Anyway, Kevin Phillip of Bel Air Investment Advisors, this is a very interesting conversation. I want to take a short break, come back, ask you more about your background. I want to talk a little bit about China and some other things, but we will first take a break. Unless you are a premium subscriber and then you do not get the break, don't touch the dial, don't go anywhere. We'll be right back. In fact, we already are. And to become a premium subscriber, visit the Substack contrarianpod.substack.com and sign up.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host and access to private channels on our Discord server. They also get generous discounts to our virtual conferences and other services. And of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information. That's contrarian.supercast.tech.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack that where you can sign up for the same prices, same benefits, same details, contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show. Okay, welcome back, everybody. Here with Kevin Phillip, Bel Air Investment Advisors, as the name suggests, based out there in Southern California. You yourself mentioned it at the top. You are from Northern California. This is the segment of the show where we try to get to know our guests a little bit better and hear about his or her background, professional background, or personal, and how he or she came to this station in life. So take it away. Tell us about that, and how things transpired to get you where you are now.
All right. I was first exposed to finance because I was good at building computers. I was hired by a team out of Morgan Stanley, Dean Witter at the time in San Francisco. Two amazing women, Karen Varnhagen, Jeanette Harris, and that became a job for me through high school and college. And I segued from helping them build computers and to tutoring their clients about how to access stuff online, then to helping them develop their marketing slides. And they were my first mentors in finance. I went to Stanford University. I studied international relations. I continued with my interest in finance. I also had an interest in the diplomatic corps and certain aspects of government. And I explored both. Most summers I was working with Morgan Stanley. Then one summer I worked in the US Embassy in Berlin in the classified section to see what that was about, and enjoyed both those experiences and came back to Stanford and settled on finance. And I met the folks at the firm I'm with now, over 20 years later, Bel Air Investment Advisors. It was the largest team out of Goldman in 97 when they left, and they founded Bel Air to exclusively service the needs of the investment needs of high net worth families and their foundations. So I met them and started with Bel Air actually before my college graduation and as an analyst. And then to typically you're there for 2 or 3 years and then you move on, and they asked me to stay, and I became one of their youngest advisors, and got to know existing clients, met new clients, and then became one of their partners. And we oversee about $9 billion for about 300 families. And I live mostly in LA with my husband and my dog, or our dog. And we also have a place in New York as well.
Very cool. Really interesting. Is there anything particularly unique about the clientele there? I mean, imagine they aren't from financial backgrounds per se out in LA, like they would be in New York or Connecticut. I would
So actually, LA gets overlooked a lot for the finance exposure. For example, Capital Group, a titan in the industry, was started in LA. PIMCO was started in LA or Newport. Trust Company of the West, TCW, that's an LA-based institution.
Canyon Capital, yeah.
And so there's definitely a strong presence. Double Line, which is a lot of spin out. Oak Tree. There's lots of great spin outs and success stories. So in terms of who our clients are, they tend to be, and the classifications have changed or evolved as I think people have in a way. We used to say about 60% of our clients are entrepreneurs who founded companies that generate tremendous cash flow or sold them or taken them public. Then there's about 30-ish%, 20 to 30% that are the biggest names in the entertainment industry we can't really talk about. And then the balance is high profile folks or not high profile folks that are dynastic kind of wealth that have found us and we work with them. And, I say that's kind of the old way we used to describe it, because I think today there's been a definite merge of any of our entertainment clients are also entrepreneurs, and they've been tremendously successful at learning that field of that angle of the business of their brand, of branding and cross branding and developing products around their identities and their brand. It's been amazing to watch and see.
Very interesting. With that type of clientele, I imagine it's more about wealth protection than growing capital. And what is that? I mean, what does one do with that? I've always been kind of, other than buy treasuries. Like, how do you lock in? How do you protect that? And even then, we've seen what the treasury market's done this last year. So,
yeah. So the unique thing about Bel Air is every client is treated singularly. There's no black box model we follow. We get to know all the circumstances. We're extremely adept at tax and estate planning. We don't practice either field, but we know a lot about them. We work with the other advisors or the other lawyers and the accountants or the business managers in those spaces. And, we are definitely the singles and doubles kind of investment people, the prudent people. We're not swinging for the fences. We'd rather underpromise and overdeliver. It's the tortoise and the hare kind of story. And if a client finds us and has that different mentality that they're swinging for the fences, it's usually not a fit either out of the gate or for very long. It's just, if we get, if that evolves that way, we just, if you're willing to if you're trying to make 30, 40% a year, that means you got to be willing to lose 30 or 40% a year. And that's just not our style.
Right. Yeah.
So you asked, how do you do that? How do you preserve that? Part of it is stay vanilla, make sure, do things you understand, avoid leverage, avoid binary outcomes, avoid blowups, stay disciplined, get comfortable with the process, have confidence in the process. Don't panic. Be greedy. The whole Warren Buffett saying, be greedy when others are fearful when others are greedy.
Yeah. Interesting. Cool. Very cool. You talked at the top of the show a little bit about, betting against the American consumer and American ingenuity. And then you mentioned working in the diplomatic corps and Germany, and we have China, of course. I realize these are disparate issues, right? But right now, today, we had testimony in DC, the CEO of TikTok saying that no way that TikTok has access to any client information. Whatever, that's what he says. We'll leave that alone for now. But what do you make of this? And China has been such a big part of emerging market portfolios and such a big part of the growth there for the last 20, 30 years. And so, yeah, where do you make of that? And what do you make of investing internationally? Obviously, it all kind of is a play on the U.S. consumer, a lot of it, but not all of it. So what do you make of that?
So there is a large segment of investment researchers that say you should weight your portfolio according to the market weight of the global economy. Bel Air has never been a believer of that. Our client base are, pretty much all U.S. based, all dollar denominated. They earn in dollars, they spend in dollars. From a point of view of accounting principles, avoiding corruption, stability of government, stability of currency, that all causes us to overweight U.S. exposure. China has been a big economic success story for, as you said, 20 years. It did have a little bit of a wind at its back because it was coming from a very small, kind of economy, and the reverse of law of large numbers. Like I mentioned before, it's easier to grow when you're small. They're now no longer small. So it's going to be harder to maintain those accelerated growth rates. So I think from just a return perspective, you kind of have to meter down your return expectations of what it was and what it will be based on simply that. Setting aside different opinion, the differences of accounting principles and or whether there is or isn't corruption, I don't any differently than the United States. Setting those two things aside, we now have to kind of ask ourselves as U.S. investors, this new kind of adversarial circumstance that has arisen between our countries, even though I think all of our populations want nothing but peace and prosperity and, sing kumbaya, unfortunately, it feels like we're getting pulled back into almost the world we were in before the Berlin Wall fell. And we're going to have kind of two competing political ideologies in the world. And so if we're going to have this kind of antagonistic circumstance that could potentially manifest in hopefully not direct military experiences, but maybe periphery, like we're kind of having with Ukraine, we have to ask ourselves if we want to fund investment and innovation in an adversarial country.
Yeah, fair enough. Yeah. What do you make of this new rapprochement between Xi and Putin that we saw just this week here? And these countries have traditionally been rivals. And a Russian friend of mine once upon a time told me that when he was a kid, at some point, he was telling me how his grandparents were preparing for war between China and what was in the Soviet Union. So this is, it's a little unusual for this to be happening. Is this all kind of smoke and mirrors to show off to the U.S., or is there something genuine there?
No, I don't think it's smoke and mirrors.
Off base, but go ahead. Yeah.
Yeah, no, I don't think it's smoke and mirrors. I think there's genuine. I'm curious what your friend says about war between China and Russia. Back in the days of the Soviet Union and China, they did have competing ideas of what constituted the most pure Marxist philosophy.
Correct. Yeah.
So they did kind of have this kind of drum beating going on, and sometimes to rally your domestic population and keep them focused off how you're doing as a government, they might rally your attention against a foreign adversary. And Russia and China do share a very long border with each other. Mm-hmm. So I'm not sure that technically, they might have had some territorial flare-ups or intentions going on. But generally speaking, today, it makes sense that for different reasons, and maybe there's some shared reasons, they would prefer a world not dominated by the U.S. Basically, since the fall of the Soviet Union, and China was such a small economy, it's been a hegemony with the U.S. leading the way since basically 1989. And a few different parties in the world are kind of done with that model, and they'd like to see that change. I don't think China wants disorder, but they don't want a U.S. only order. And then, Putin, I'm not sure he has a specific order in mind, other than, maybe through chaos, brute strength. He seems to have this philosophy, which, he practiced in Syria. It's easier to rule a country when there are fewer people in it. Yeah. So, send them off war conscriptions and, bomb the heck out of them and rule an empty country. It feels a little bit like,
Yeah.
but I think their alliance is real. It's concerning. It's a change of the geopolitical arena in the world. Russia does not play a huge role, as a percentage-wise financially in the markets, but they sure can cause a lot of trouble.
Yeah. So then what does one do as an investor other than de-risk or prepare or keep an eye on it?
Well, if the world's going to be a little bit more chaotic, it's going to be more confrontational, and you don't have, it means you need more investments in security, defense, and you need to be less exposed to geographies that could be pummeled by those circumstances. So, without getting in, or at the very least, you just stay out of those, you focus more on just the U.S. consumer, maybe Western Europe, what they offer, which is, there are great companies out of, Western Europe, UK, Japan, South Korea, Australia that provide goods and services that we Americans love and that people all around the world love. So there's plenty of opportunity to find investments. There's Africa, there's rising opportunity in Africa. Some are aligning more with, quote unquote, the other side, and some are more towards us. So, there's opportunity. There are opportunities everywhere. It's just a question of what you feel comfortable participating in.
Yeah. Any thoughts on Taiwan? We've had people on the show and they said that, look, China would love to invade Taiwan, but they can't because we'll cut off their oil shipments there in the Middle East and with our Navy, and that'll be the end of that. Any thoughts on that?
I have a lot of thoughts, but I don't know if I have any answers. It's really complicated, and there's a saying in international relations, and when you look at international security, that domestic politics trumps everything. I don't mean to use that. I don't mean to use the Trump's word with any sort of pun. I just mean domestic. So I think sometimes what seems to be reasonable and rational from like an international perspective gets totally overruled because of a domestic political need. So, if Xi ever feels threatened to what seems to be a life reign for him, and he needs to rally the troops and wave the flag, and he needs to do that by being more aggressive with Taiwan, he'll probably be more aggressive with Taiwan. And, the American people they get pretty war weary. And I think everybody knows that. That's no secret. And, he knows that. So I worry a lot about Taiwan. And I think the circumstance in Ukraine, everyone's comparing to it. And there's definitely comparisons to be made. And I think what we're trying to demonstrate is the best way that we can be prepared for that is to help people defend themselves. Because the American people will get weary of doing it for them and losing lives for distant lands.
Sure, have seen that several times, haven't we?
Yeah.
All right. Not a very great way of closing here.
Well, we should end on an upbeat note because I think
on an upbeat note. So tell me.
I think what we've seen here is we've come out of an unprecedented period of the global economy. Who would ever imagine that we'd have the world shut down, us stuck in our homes, interest rates go to zero for as long as they were, and here we are now, kind of maybe a year-ish emerging into normalcy. The Fed has apparently gotten monetary policy much more towards normal. You can argue they've broken things, but I don't really think they've broken anything fundamental. Okay. They have more tools in their belt to fight a crisis if it arises. You have kind of a split Congress that means stagnation, which, the market likes stability of rules. If it knows what the rules are going to be, it can plan around it, whatever the policy is. So because of the fragmented Congress, we're probably going to have stability of rules. We have a monetary policy that's closer to normal. We got to get our fiscal, we got to have an idea of what we want to do fiscally as a country, but that probably won't change much with the Congress. So I think going forward here, we've gotten pretty far out of this crisis, and we can look forward to a growing, stable U.S. economy that surfaces here in the next 6 to 12 months without going what feels like from crisis to crisis to crisis.
That is indeed very optimistic. Kevin Phillip, thank you for that. Maybe in closing, you can tell our listeners how they can find out more about you, more about Bel Air Investment Advisors. I don't know if you're active on the social media.
The best way is, I'm not terribly active on social media, but our website is www.belair, BELAIR -LLC.com. All of our bios and team is there, and contact information is there. And thanks for having me today.
Yeah, thanks for coming on. Very interesting conversation. Thank you all for listening. Thanks to Kevin for making himself available. And we look forward to speaking to you again next time. See you then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.